Well, to no one's surprise, the BOC increased interest rates 0.25% to 5% today. This represents the first time since 2001 the Bank of Canada's overnight rate has been at 5% or higher, and it represents the 10th rate change that we've seen since the beginning of this rate cycle. These are pretty significant pieces, but it's not all bad news, and I'm going to explain why in this upcoming video. Alex McFadden here at Flow Mortgage Co. along with my trusty mortgage pug. And today we're going to talk about the Bank of Canada on July 12th 0.25% increase and how it actually impacts you. But more importantly, what's happening to why they made this 0.25 point decision. So the Bank of Canada came out this morning and made a decision to increase rates by 0.25%. This obviously impacts those who have a variable rate mortgage, an adjustable rate mortgage, and lines of credit pretty significantly. But digging a little bit deeper into the decision that was made today, some interesting feedback was provided. First and foremost, in July, it was the first time in a long time where we actually saw inflation start to come down, specifically to 3.4%, which is a huge drop from the summer of 2022, where the numbers were at 8% plus. So why are we still raising rates? Well, one of the primary reasons is that inflation came down primarily due to outside considerations like gas and oil and these factors, which don't necessarily help us in the inflation war when we're looking for things like increased unemployment. So essentially people losing jobs or not having as many jobs available. We're looking for things like job wage growth slowing down. So the government doesn't want to see everyone getting raises. And of course, the most important thing, and this is the most impactful for all of you, is the government's really basically, or the BOC I should say, is basically looking for a reduction to increases in prices. As you know, over the last years, we've seen everything from pop bottles to coffee cups go down in size, but the price go up. They want that to stop immediately. In order to do that, they need to see people stop making money, not having as many jobs, and less money circulating, which is why the Bank of Canada has increased rates. Now, this is the first time in a long time that we've seen any type of positivity from the BOC. In fact, Tiff Macklem, he's the one making the big shots here announcing, has indicated that we may be close to the beginning of the end. This doesn't mean they're going to for sure stop raising rates, but it means that there is a positive sign. And this comes back to the fact that it looks like we are finally seeing inflation start to slow back down. So what does this mean to current variable rate holders? Well, first and foremost, if you have a fixed payment variable rate mortgage, you probably hit your trigger point. At this point, the bank's probably reached out and you have a few options. Number one, you can just increase your monthly payment to make sure you're paying off some of the principal. That ensures that you have the lowest payment, but you're not going backwards in your amortization. Number two, you can choose to do a lump sum. Same concept, but you're paying it all at once. And number three, you can choose to lock in or refinance elsewhere. Now, we always suggest before locking in or refinancing, you have a discussion with us because quite frequently your bank is not going to offer the most competitive terms. Beyond that, if you have an adjustable rate mortgage, you're going to see your payments increase by about $15 per every $100,000 borrowed. And of course, if you have a line of credit, this could impact your total cost of borrowing. For people who are pre-approved, the only real impact will be those who are using a line of credit to borrow money for the down payment, and or some of those, very few, who have a variable rate mortgage as their rate hold. Now, for everyone else, we've seen fixed rates increase about 1% over the course of the last 2 months. And so we've already seen the market start to slow down in certain areas of the country. And this represents a big opportunity, an opportunity for those who are well capitalized, have access to the cash, and well qualified to get a mortgage. It represents an opportunity to have less competition in the marketplace, and more importantly, for people like buyers and investors who are, again, well capitalized to get a great value on a home. Now, do we expect home prices to crash? No. By all accounts, the economy is very strong, but we're also suggesting that home prices will probably maybe soften in certain areas, maybe not hit the peaks that they were seeing in the May to June range, but probably not go down significantly. And a big reason for that, we have so much lack of supply at this time right now. We're not building enough real estate. And ultimately, what that means for buyers is that, again, there's a limited amount of supply. So what next? Well, the next Bank of Canada decision is in September of 2023, after the summer months. And this should be enough time to see or determine whether or not there will be any more positivity in regards to inflation and the war on it. Overall, these things can take some time. 6, 12, or even 18 months is really the reasonable timeline at which when we hit a peak before we start to see a major impact on the overall lending environment. So the BOC is suggesting that the first time we'll probably see rate cuts will be sometime in 2024 and nothing major until 2025. So for those who have mortgages coming up for renewal in the next 1 to 2 years, you need to be having conversations with someone to make sure you have your ducks in a row so you're not shocked by the increases. For more on this and any other questions you have about real estate, make sure to reach out to us. And of course, if you haven't already done so, make sure to hit that subscribe button below so you can get all this information as soon as possible.